Let's be brutally honest for a second. Most people think the top 1% have access to some magical vault where they pull out gold bars, secret Wall Street handshakes, and stock tips nobody else can touch. The reality? That's a myth. The ultra-wealthy aren't sitting in smoky rooms plotting how to keep you broke. They are just playing the financial game differently. And more importantly, they're often investing in places most people don't even know exist or don't understand well enough to take advantage of. The truth is, the gap between someone with a $50,000 salary and someone sitting on a $50 million fortune doesn't just come down to working harder. It comes down to access to investment vehicles that multiply quietly in the background, while everyone else runs in circles with penny stocks, side hustles, and get-rich-quick scams on TikTok. Today, I'm going to pull back the curtain and show you 5 hidden investments that only the top 1% seem to know how to use. And here's the best part. While not every single one will be accessible to someone starting at zero, every single investment has a way for regular people to get closer to the game. I want to teach you exactly how to think, act, and plan so you can start using the same blueprint to build lasting wealth, whether you're starting with $50 or $50,000. And don't miss the powerful, conclusive takeaway at the end. If you're ready to unlock your potential and achieve more, hit subscribe. We're dedicated to delivering actionable tips and real-life success stories. Let's get started. Number 1. Early IPO allocations. Let me start with a story. A guy I once knew worked at a small startup that was later acquired by a massive tech giant. He wasn't some coding genius or CEO. He was just on the finance team. But here's the kicker. Because he worked there early, he had access to employee stock options when the company went public. His small $10,000 allocation turned into more than $700,000 within 5 years. No lottery tickets, no gambling, just being in early. The top 1% make their money before the headlines hit CNBC. They negotiate with underwriters, they're part of private placement deals, and they sometimes even fund seed rounds long before the IPO is a whisper on Reddit. So what's the average person supposed to do if you weren't born a Silicon Valley insider? Here's the workaround. Fractional investing platforms and specialized ETFs. Some funds are specifically designed to scoop pre-IPO equity or private company shares before they go public. While this isn't as sweet as being the original investor writing $1 million check, it's still a chance to get closer to the action than just buying on the stock market launch day. The shift here is realizing you don't make exponential wealth by chasing hype. You make it by getting in before the world cares. Whether you start by studying IPO-focused ETFs, joining investor clubs that pool money to access private equity, or even working for startups that offer equity packages instead of just a salary, this hidden lane is one of the fastest paths to long-term equity growth. It won't make you instantly rich tomorrow, but 5 years from now, you'll thank yourself for not waiting until every news channel screamed about the next tech unicorn. Number 2. Hedge fund openings. If I whispered the words hedge fund to most people, they'd roll their eyes and think of Hollywood movies with Wall Street sharks screaming on phones. But hedge funds are not just wild bets. In reality, hedge funds are playgrounds for diversified wealth-building strategies. Think about it. Complex positions using bonds, currency, commodities, options, and equities, all managed by some of the sharpest financial minds on the planet. While average investors are looking at whether your purchased stock will go up or down 2% this week, hedge funds are running mathematical models that smooth volatility, seek asymmetric returns, and, most importantly, protect downside risk. That's why they've historically attracted billions. Now, here's the catch. Most hedge funds are gated behind ridiculous requirements. Think minimum $1 million investments or even more. That's why regular people never touch them. But there's a secret the wealthy already know. Some hedge fund strategies are mirrored in liquid alternatives, publicly available funds that mimic hedge fund playbooks but are accessible with as little as $1,000. For instance, long-short ETFs, merger arbitrage mutual funds, or volatility hedge products exist right in the open. Wealthy investors diversify with hedge fund allocations, so their portfolio isn't entirely tied to whether the S&P 500 has a good year or not. And you can apply the same principle by layering in small allocations of alternative strategies alongside your index funds. The key mindset shift is this. The rich don't swing for the fences with every dollar. They build portfolios resilient in storms. Middle-class investors often panic sell in downturns, but hedge fund-style strategies are literally designed for downturns. Even if you cannot write the check to some secretive NYC fund manager, you can still start thinking the same way. Protect your capital, exploit inefficiencies, and stop guessing blindly. Treat your portfolio like a machine, not a casino. Number 3. Pre-development real estate deals. Everyone hears invest in real estate like it's an inspirational poster. Buying rental properties and waiting for stock market appreciation is great, but what the top 1% do is a little more clever. They don't wait for skyscrapers to get built so they can overpay for a condo unit. They buy in the dirt stage, pre-development projects where prices are low, risk is high, but gains can be astronomical. For example, let's say a developer wants to build luxury apartments in a growing city. Before construction even starts, investors can buy pre-sale units for, say, $200,000. By the time the building is completed and marketed to the public, those same units might sell for $350,000. That's equity growth without even owning tenants yet. Multiply that over 5-10 projects and you've got cash flow potential on steroids, often before the average investor even knows the property exists. Now, realistically, this requires capital and access. But here's how you bridge the gap. Real estate crowdfunding platforms. They've completely revolutionized access to pre-development opportunities by pooling small amounts from everyday investors. No, it's not the same as personally writing a $500,000 check to lock a floor in a skyscraper, but even putting $500 or $1,000 into a pre-development project teaches you how powerful early ownership can be. Access is widening if you know where to look. The mindset shift is simple. Don't get stuck only thinking about buying existing rental properties. Look upstream at the birth of real estate itself. The wealthy don't just buy doors, they buy opportunities before the doorframe even exists. Number 4. Dividend-paying ETFs with asymmetric structures. When most people hear the word dividend, they think safe, boring, slow money. But do you know why the top 1% love dividend-paying ETFs? Because while the rest of the crowd is obsessed with chasing meme stocks, the rich understand the power of predictable cash flow. Dividends are like financial oxygen. You don't always notice them, but they quietly keep you alive through volatility. Here's where the underdog advantage exists. These ETFs are available to everyday investors with the click of a button. You don't need insider meetings or private banker connections to get them. What you do need is patience, discipline, and a willingness to hold while others panic. If you invest $500 a month into high-quality dividend ETFs and reinvest every payout, in 20 years you could realistically be sitting on a six-figure side portfolio purely from cash flow growth. The mentality shift is brutal but true. Chasing explosive returns is sexy, but boring money builds mansions. Wealthy people don't complain about a 6% yield compounded over time. They quietly let it snowball until that passive income covers their lifestyle. The secret is to start small and start now. Number 5. Private credit markets. Here's one almost no one talks about: private credit. While banks tighten lending and middle-class families struggle to get approved for basic loans, the wealthy are on the other side of the equation. They're not borrowing, they're lending. Private credit funds allow investors to step in where banks step back, financing businesses, projects, and real estate deals in exchange for fixed interest and fees. Returns can range from 8% to 12% annually, dwarfing regular savings accounts or government bonds. The beauty here is stability. Instead of praying for stock market appreciation, you're earning consistent cash flow by being the bank. The ultra-wealthy have multi-million-dollar portfolios, feeding steady monthly distributions through senior secured lending. This is why their financial security barely wobbles, even when the stock market is tanking. The key shift here is thinking like a lender, not a borrower. Most people live their entire lives on the debt treadmill: mortgages, car loans, student loans. The wealthy flip the game and become the entity collecting interest. Even if you start lending $100 a month on micro-loan platforms, you are psychologically stepping into the mindset of the bank. And once you think like the bank, your wealth trajectory changes forever. The real secret of the 1% isn't just the specific investment. It's patience, discipline, and the systems they use to stack cash flow while protecting downside risks. You don't need to be born rich to play the game. You need to stop buying the myths and start buying time, patience, and opportunities early. Wealth isn't built by chasing shiniest trends. It's built brick by brick, disciplined decision after disciplined decision. So next time someone whispers, "The rich have access to secret deals," smile and realize you've just learned exactly what those deals are. And now, it's your turn to start using them. If you got value today, give back with a like and a subscribe. It's the easiest way to say, keep going. Now, if you want to know early retirement secrets you won't hear in financial news, then watch this video. I'll see you there.